A typical market could be either bullish, bearish, or may display sideways condition. And so in this video, we want to look at top 10 bear market traits or characteristics or features every investor should know. A bear market is characterized by prolonged period of declining stock prices, typically, by as much as 20% or more from recent highs, and it's often associated with widespread pessimism and investor fears. And so here are some key characteristics of a classic bear market. Number one is significant price decline. Significant price decline. And so price of stocks can drop by as much as 20% or more from recent highs, typically across major indexes like the Standard & Poor and like the Nasdaq. And so when there's a general drop in prices of stocks in the market, or the entire index drops by as much as 20% or more than that, that is a typical characteristics of a bear market. Number two is negative investor sentiments. Negative investor sentiments. And so widespread pessimism and fear dominates investor behavior, leading to a more selling than buying. Leading to more selling, than people sell their stocks than they tend to buy. They keep on dumping and dumping and dumping their stocks, selling and selling, and with little or no buying in the market. That is a typical characteristics of a bear market. Investors tend to they lost confidence in the market. They display fear, and they are kind of pessimistic. So they tend to buy less and they sell more. So the more they sell, the more stock prices plummet, aggravating the bear market condition. Number three is high volatility. Market experience increased volatility with frequent and sometimes extreme price fluctuations. The market becomes more volatile as people keep on dumping their stocks. Then the entire market, responds accordingly. And the price fluctuation is kind of, is on the extreme, relatively, higher than what is expected. That is an indicator of the fact that the market is experiencing a bearish sentiment. Number four, economic weakness. Economic weakness. Bear markets often coincide with or are caused by economic downturns such as recession, recessions where the gross domestic product, the GDP growth slows and unemployment rises. When there's a rise in unemployment figure and it's also a drop in GDP figures, then that would signify a poor economy, probably on a recession, and the recession definitely will affect the stock market. This will introduce a bearish sentiment in the market. Number five is decreasing corporate profits. Decreasing corporate profits. Company earnings generally decline, which can lead to lower stock prices or future prospects or future growth prospects for the company. So when the company generally, as a general trend, they're reporting either losses or lower than expected level of returns, then that would cause investors to kind of pull back. They may not buy as much as expected. That will lead to a general decline in the market, and invariably it will result in a bear market. And not only that, it presents a kind of a gloomy prospect for growth in the company performance, a gloomy prospect of a growth in share prices. And so this particular condition is a typical indicator that the market is bearish. Number 6 is low trading volume. Investor confidence wanes, leading to reduced trading activity and lower market liquidity. So when there's low trading volume, traders don't move much volumes as they usually move in the market. They don't really trade much, and then liquidity becomes low, in the market. These are indication of a bear market. Investors' confidence is no longer as its height like it used to be. Please subscribe to this channel, like this video, and give me a thumbs up. Number 7 is a flight for safety. Investors often move their money into safer assets like bonds, like gold, other precious metals, or cash to protect their capital from further losses. They tend to they exit the markets, en masse, and seek safety, in safer assets that don't really correlate that much with the economy, that don't really, respond to negative economic trends like precious metals, as I mentioned earlier. Number 8 is falling valuation. Falling valuation. Stock valuation, such as price to earning ratios, decreases. As market prices falls faster than earnings. Usually, you discover that the PE ratios of the market entirely will do what? Will decrease, because the level of stock price decrease is even faster than earning decrease. And so once stock prices is decreasing at an alarming rate, and compared to the decrease in earnings, that will lead to an overall fall in valuation of stocks in the market, in valuation of securities in the market. Number 9, bear market rallies. Bear market rallies. Temporary price increases or relief rallies, as it is normally called, occurs within the broader downtrend, often luring investors back into the market before price will drop again. What is called, if I'm not mistaken, a dead cat bounce by traders. The market is down temporarily, attracting investors who are lured into the market by lower prices, and as they come into the market, the market will plummet again, increasing their losses. These are all typical features of a bear market. Number 10, extended duration. Extended duration. Bear markets can last for several months or even years, with the average duration being around 14 to 16 months. So it can take time. Unlike the bull market that started immediately after the financial crisis, it lasted for almost more than 10 years. That was a fantastic level of growth, bull market dominance. And so the bear market can equally occur for an extended period of time. So understanding these characteristics can help investors better navigate and manage their portfolios during challenging market conditions. You need to understand this. And so once you understand what is happening, it will help you to plan, on how to mitigate the losses you may sustain, and also to take advantage of a subsequent bull markets, as the case may be.